decoding a term sheet. The term sheet will be one of the most important documents you will ever sign, and having a thorough understanding of important things is always considered to be immensely helpful. I would like to invite Mr. Mukul Singhal to teach us how to decode a term sheet. Mr. Singhal is the co-founder and partner of Pravega Ventures, an early-stage VC fund based in Bangalore. Pravega Ventures is an early-stage venture capital investing from seed to Series A round. They have invested in nearly 25 startups up to date, including exits from some top startups like Urban Company and Purple.com. Mr. Singhal has over 15 years of venture capital investing experience in India. In the past, he has led investments and served on the boards of many companies such as UrbanClap, Industry Buying, TravelTriangle, NoBroker, AutoNinja, PropTiger, Bobble App, WorkX, Growbox, and Tracxn. He invests in consumer internet mobility and marketplace platforms. A very warm welcome to you, sir. The session is over to you now.
Thank you, Kapil. Thanks for giving me the opportunity. Good morning, all participants, all founders, aspiring founders, all the audience. Good morning to for this, and I hope that for next 1 hour we'll have some interesting and some exciting session on term sheets. Kapil, I'm sharing my screen and see if my presentation is upcoming. Kapil, can you give me a...
Yes, it is visible. Yeah.
So, participants will next 1 hour will try to give you some concepts on term sheets. How do you decide? How do you decide on various options? How do you see what is best for yourself? Obviously, ideal case scenario is never there. You have to give something and take something. So how do you decide? How do you do that decision making? Is what to decide, when to decide, what to give up, what not to give up. Just a small disclaimer: in next 1 hour, the term sheet discussion can go a little bit technical as well. But if it goes technical, you can raise your hand or you can shoot questions, or after the session we can have a Q&A session. But it can go a little bit technical. I'll try to repeat it as much as possible. Just a small introduction for us. I represent Pravega Ventures. In this session, I and my colleague Garma Agrawal is also among the participants. Both of us are here to help you understand the nuances of term sheets. Just a small introduction on Pravega. We are an early stage venture capital fund. We invest into pre-series A and a sweet spot. Classic check sizes is anywhere from $1 to $5 million. So invest into early stage companies, help founders for a product market fit, and hope and keep on participating in their future journey of company building exercise. So for the way I have outlined this session, I'll talk about term sheet. We'll figure out. I know that there is a session on valuation already, but here in this session we'll talk about how the term sheets structure valuations. What are various possible ways of presenting valuation to the audience set? How do you decide that what possible structure? So we will not debate how to reach to what is the right valuation of my company. That I assume that session is already done and you have got something from there. But we will discuss that what are the various structures which are used to arrive that number. How do you decide that what structure to use, what is not used? How do you go with that decision making? We'll go through few key clauses and term sheets. What are the legal implications and what are the key broad things you should keep in mind? Fundamentally, a basic introduction on term sheet, guys. Term sheet is nothing but it's a letter of intent from a venture capital fund. It's a non-binding contract. And what does it mean? Non-binding contract means that term sheet doesn't bind. It's not a done deal. After term sheet, VCs or investors, whoever is coming, they may do a diligence on the company. They may find out something and they decide that they are not willing to move ahead. So don't take term sheet as a done deal. Obviously the idea, it's a 80-90% probabilistic event, but still there are multiple examples of fallen term sheets or investors taken back their term sheets in mid process, and the reasons can be many, and there is, it's very difficult to explain what are the various possible reasons, but term sheet is just a non-binding letter of intent document. Having said that, it helps you that what will come in a final contract. So after term sheet you get a share subscription agreement and shareholders agreement, and those agreements are typically a larger ballooned up contract of your term sheet. So if you understand your term sheet well, then at least the commercial contracts, the key terms and conditions will come to you in a longer documents, and you'll be able to understand them properly. So starting with valuations, I think I have seen founders in last 10-15 years, and typically at early stage, it's fairly tough to understand that what is the right value of my company, how much fundraise, what is the timing, is it right timing, shall I raise early or shall I wait for 6 months and hence my valuation can be more, what would be my dilution? So like multiple questions do come into your mind when you start off thinking a fundraise process, and especially if you're a first time founder and you are raising capital first time, then all these questions are fairly valid questions. Typically in my career, I have seen three possible ways of structuring valuations. And obviously you can make on every possible way, you can make it complex, but I will put these things into three larger buckets. One bucket is the first one is the direct equity funding, which is a very simple valuation exercise that, look, this is pre-money, this much is raised, this much is post-money, and then done deal. So it's a fairly simple way of approaching towards valuation. Second way, these days convertibles are fairly fashionable. They are fashion of the day now. People like to say that, okay, take 100 rupees convertible on next round, and we'll talk about more that what all it means. Third is a little bit of a tranche structure, that you take X money, X 50 rupees on this valuation, and then based on some milestones, you take more 50 rupees on this valuation. So those are tranche structures, and those are the largely three possible ways where I've seen valuations and term sheets. First one is very simple. I hope all of you are wiser now after your valuation sessions. I have just taken one example. Your pre-money is 6 million. You are raising, your pre-money is 8 million. You are raising $6 million. So your post-money becomes 6 plus 8. And you end up in diluting 6 divided by 14, 43% to your incoming investors. It's a fairly simple, straightforward mechanism of approaching towards valuations. Second is like fairly convertibles, and I'm sure that you guys will be seeing convertibles these days. It's, for me, it's like fashion of the day. Last 5-6 years, everything is happening on convertible rounds. And fundamentally, what is the need of a convertible? Let's understand that. One reason I've seen is that founder is saying that, look, my company will do very, very well. I am letting you enter at point A, but I want you to value for the future round, let's say point B. So give me money today, but it should not be valued today, and it should be valued at some point in time in future. Or another reason why I've seen people approaching to convertibles is that there is a big difference of valuation in founder eyes and investor eyes. Investor is saying that, look, I love you, I like you, but in my opinion, your value is $10 million. But founder says, no, Mala, these are the reasons, and my contract is in the process. In next 1 month, I'll sign a big contract, and hence my valuation will become $30 million. So it's a big difference of 3x. If you are not able to come to a common ground, and both investor and founder agrees, then people reach to some convertible formula that, look, okay, investor is investing money today, but it will get converted at some value in future. So those are the largely reasons that you are not willing to value today, or you have a very different opinion of value, what the external universe is saying. Those can be those are the larger reasons I've seen these convertible rounds happening. Again, same thing, founder logic is this, but when founder says this, investor also says that, look, there is a risk from now and then, isn't it? You are saying you will sign the contract, but what if it doesn't get signed? What if it get failed? And what if it not get valued at $30 million? And my money is contributing to the growth of the company, so the money should get rewarded, isn't it? So there's a difference of opinion between how the founder is seeing the business and growth, and investor is seeing business and growth, and obviously investor wants to value the risk. And to incorporate these differences, convertible rounds carry few terms. So they can be like discount to next round, time link, discount, floor and cap, and a typical convertible deal will look like this. And let's spend 30 seconds on this slide so that you can get it. So it's like investing $5 million convertible to Series A. So let's say Series A is going to happen in 12 months, 18 months. So I'm investing $5 million today, but it'll get converted at a valuation when I raise a Series A round. And these are the classic terms which investors put in to incorporate their risk. So somebody can say that, look, you give me discount to next round because I'm putting today. It's fine that you are not valuing it, but whatever value you get in 12 months, give me discount today. So those discounts can range from 10% to 30-35%. I've just taken an example of 20% discount to the next round, but it's a very classic and very typical terms which comes into convertible deals. Second convertible typical thing which comes with a floor and cap. So founder says that, look, let's put some floor because if you don't put any floor and next round is happening at some low value, then the then the valuation with discount can become very, very low. So founder says put some floor to it that at least this much will get valued, and the investor says then put some ceiling on it. Cap pre-money is this, the minimum is $10 million, maximum is $20 million. So that's how typically I've seen convertible rounds carrying these terms. And the third, to make it more complex, an investor can say that, look, founder, you are telling me that in 12 months you'll be able to raise capital, but what if you're not able to raise capital in 12 months? What if it is 3 years? What if it is 4 years? And then I have seen people putting in clauses where the discount keep increasing based on the time. So I've just taken a small example. Discount increases to every quarter. So if after 12 months, if you're not able to raise money in Q1, then discount will become 22%. In Q2, it can become 24%. And this every quarter can become even every month. I've seen structures where like 1% every month. So after 18 months, if you're not able to raise capital, then my discount will keep increasing every month by 0.5%. So all these kind of structures I have seen in convertible structures. I'll pause for 5 seconds for you all to let it digest, and before we analyze what should you do if you are sitting in such a situation. Okay, so basically, guys, in convertible rounds, I'm a little bit stepping back. You guys, right now, I've seen that it has become a fairly trendy and fashionable to have convertible rounds, and people want to do convertible rounds without understanding the reason for it. And my basic request to all the founders is that you should do your math when you approach and when you fight or argue or negotiate a convertible round. For example, if your floor and cap is not very, very wide, if your floor and cap is not very wide, then let's say if you have so let's say you have given an option of doing a straight jacketed equity round like we have gone here, pre-money of $3 million and you raise on 8 million pro, or you are giving some logic of convertible in this form, and you want to take convertible because you think my value will increase because I'll get valued in future. But you should be very, very careful in approaching these rounds. If you are given these three conditions, so third condition in my opinion is a big no-no. company building is a fairly risky exercise, and you never know what hits you in future. And for example, I'll give you a typical example like a COVID scenario. All of us are coming in COVID scenario. For first 6 months of COVID in 2020, deal making practically stopped because everybody was figuring out what's hitting them. And if you have done a convertible round, this kind of a structure in 2019, and then will be a very, very tough time to honor the 12 months timeline. Your business got hit, and no mistake for by yourself, and but the contract is contract. Second, anything can happen in business. You are doing a small pivot, you are taking time. So my recommendation is always, if you're doing convertible, one, you should do your math, try to compare your options as a straight jacketed round and a convertible round. And then if you are thrown away with this time linked convert discount formula, I've hardly seen it working, because things do change. Time invariably increases, and your discounts become very, very penalizing to the founder. To do second thing is, when you do your math, if it is a floor and cap, and the difference between floor and cap is very, very less, then at times it just doesn't make sense. You will end up in diluting the same equity as you would have done a straight jacketed round. I don't have a mathematical example for this, but if you do it in Excel and pen and paper, you realize that convertible rounds is not too different from what you have done from a straight jacketed round. So my request is that whenever you are thrown with this, do your math, compare it with your option, and then take a call. Second big driver of a convertible round, typically I have seen where it totally makes sense, is if you are taking money from angels and a small capital coming at different point of time, then convertible is an easy way to do it. And the reason for that is because every angel is very small, nobody is willing to value it, and everybody is just putting $10,000, $20,000, $50,000, $100,000. You put some convertible number and keep raising money for 6 months, 7 months, and 8 months. In those scenarios, it does make sense. But if you're raising a very chunky money, like $3 million at a convertible, then you should do your math and try to compare it with your straight jacketed round. Next is the tranche structure, and again, this is a fairly interesting where I've seen founders falling in the trap and not able to differentiate properly what is good and what is bad. So just take two examples. That one example is that the pre-money value is 4, total funding raise is 6 million. So let's compare it with another example. So you have a straight jacketed deal, and you don't want to take that, but the VC comes and gives you a second deal which says, look, I am happy to give you same amount, let's say $6 million, but I can't give you the valuation which you are willing to ask today. So what we will do, we'll equally distribute in two tranches. You take $3 million at a lower money, and I'll give you another $3 million at a higher valuation of your choice, isn't it? And you think that your post money value will increase, you will look good, da da da. So again, in that sense, you will do your math. If you do your math of both the tranches working out, and you take the right one, then I have done a small math at the lower part of the presentation. You should figure out at the end of tranche 2 how much you will end up in diluting and for what capital. So answer is that for $6 million, you will end up in diluting some percentage, and your valuation is like $11 million, which is lower than $15 million, which is fine. But you should figure out what is your effective valuation, and what you are not just go on the tranche 2 post money valuation. You should figure out what is the effective valuation which is coming out at the end of the tranche 2, because in tranche you are taking an inherent risk of money not coming to you, the full money not coming to you. So let's say your need is $6 million, but if your tranche is 3 plus 3, then in first shot you are just getting $3 million. You are not getting another $3 million for sure, because there will be some condition for the another $3 million. And at times investors want to put some KPIs, some metrics, for another tranche, because he's valuing your number more, he's valuing your company more. So in that sense, again, you have to be very, very careful. You should try to figure out if your first tranche money is enough for you to do what is asked for the second tranche of money. You can do your KPIs. Typically in early stage, founders end up in doing lot of mistakes while budgeting. They invariably they end up in under budgeting most of the cost, and cost do overrun when you start a business. And fundamentally you have taken a risk of $3 million coming late to you, or not coming at all. If you're not able to do your KPIs, then that $3 million come in risk. So again, I think when you compare all these three mechanisms, you should not come in the trap of fancy things like post money valuation, or second, or your valuation keep on increasing with conversions, or tranche. You should try to do your math, compare all the three options, how much you are able to dilute and how much you are able to raise, and then take a call, rather than taking a call without knowing it. So in my view, see, valuation is a mechanism to raise capital at the price of founders' equity. So the only two things which is important for me in this discussion is how much money you are getting and how much you are diluting. Everything else, believe me, is a noise. So you should think hard how much money you are raising and how much equity you are diluting. Valuation is just a kind of an input variable to achieve a certain outcome, and it's not the end goal which you should try to maximize. Uh, in early days, you should think hard how much money to raise and how much equity you to dilute, and try to compare all the three options. So pretty much this is on the valuation. I'll little bit again take my slide to first slide. There are three ways to structure: is direct equity, convertibles, and tranche structure. Convertible, you should do your math. At times, convertible is not giving you anything different from direct equity funding. They are just complicating your paperwork and complicating your rounds. So it's better just to go to direct equity at times. And when you get tranche structure against direct equity funding, you should figure out what is the effective valuation you are getting at the end of tranche 2, tranche 3, whatever it is, because fundamentally you are taking a risk on tranche 2 or tranche 3 based on the KPIs you are asked to achieve. Any future capital is a risk in the business which you should get rewarded for. Okay, this is on valuation. I hope we'll go for questions in the end. But other clauses, let's talk about other clauses in the term sheet. These are few clauses which I picked from term sheets, which are, in my opinion, are important. You should know it. Liquidation preference, founder vesting, ROFR, buyback, anti-dilution. I'm sure that you would have heard, if you have heard about term sheet, you would have heard some of these terms. Let's take them one by one. So liquidation preference is fundamentally investors is trying to protect his or her base case. So investor says that, look, if you're selling your business in the future, I want to carve out, or I want a preference to get certain dollar amount first. So let's say if you're selling your business for 50 rupees, I at least want 30 out of it. No matter how the size of the outcome is, I just want a certain specific number first. So that is a fundamentally called liquidation preference. There are we have put in three type of liquidation preference, but fundamentally they can be bucketed into two parts. One is a non-participating preference, and another is a participating preference. In participating preference, you can put it capped and uncapped, but they are kind of participating. So in non-participating liquidation preference says that whatever amount I am investing as an investor at the time of liquidation or M&A or exit or sale, I'll take 1x of higher of 1x of this amount or pro rata of my shareholding. So we'll come back with mathematical examples in the next slides. But fundamentally, I'm saying I'm taking higher of my cost or my pro rata of my equity. So it is higher off, and that's why it is non-participating. I'm not part. I'm just take either or. The participating is a little bit penalizing and a little bit tricky, and cumbersome for founders. In participating, I am saying that, look, first I'll take my cost out, and then whatever is left, we will divide it in the ratio of our ownership. So and hence this is called participating. We'll come back in some of these examples. Now take these. I think this is a little bit. Just think about the first example first. Don't just leave these second things. Just focus on the first example, which is scenario one. So let's say there is a $10 million and 30%, and I have invested $3 million. So in the non-participating 1x, I'll say greater of 3x or 10 million, which is 30% of I think these maths is not written right here. Fair point. So the example is that, let's say I have invested $3 million in the company, and I own 30%, and 30% amount is coming to $10 million at the time of exit. So the non-participating says that I'll take greater of my amount or what is pro rata, and pro rata is $10 million. So obviously I'll take $10 million first, and I'll let go the first part. And if the amount is very small, if the amount is just $2 million, let's say you're exiting for $2 million, and I have invested $3 million in the company, then I'll just take the entire $2 million, and you will not get anything in that. Okay, sorry, I'm just stepping back again. These are for the first non-participating preferred. These are three scenarios. In scenario one, exit is $10 million. Scenario two, exit is $20 million. Scenario three, exit is $75 million. So in the non-participating preferred, the amount is greater of 3 million or 10 million. So I have invested 10 million. So I'll take $10 million, and you won't get anything. In the second, in a $20 million exit, again, 30% of 20 million is 6 million. And I have invested 10 million, so I'll take 10 million. So you again don't get anything. You just get 10 million. So you get 10 million, I get 10 million. Having said that, in a $75 million exit, the 30% of $75 million is 22.5. So when I say greater of 22.5 or 10, then I'll take 22.5, and you get pro rata of your 70%, which you get a 52.5%. So that's how it is. So it is non-participating preferred. Scenario one is $10 million exit. Scenario two is $20 million exit. Scenario three is $75 million exit. I'm just stopping 10 seconds for you to absorb this part, the non-participating preferred. The second, in uncapped participating, what I am saying that give my 10 million first. So in a $10 million scenario, you won't get anything. In a $20 million scenario, I'll say give my $10 million first, and then whatever is left. So when I take $10 million first, I left with $10 million. 20 minus 10 is 10, and then I'll take 30% of another $10 million. So you get 13 million, and common stock get rest of it, and the similar of this scenario. So participating is I take mine cost first, and then whatever is left, we share the deal in our ownership. In non-participating, it's greater of my cost or my share in the deal. So whatever is greater, I optimize for that, and that's how it plays non-participating. The variables in liquidation preference happens is that this number of non-participating can vary. So right now we have given you an example of 1x non-participating, but people can put it 2x, 1.5x, 3x in that fashion. So people can play with that number. I hope. People get it. I think the things to keep in mind in participating preference, things to keep in mind in liquidation preference, guys, push back hard if you're getting a participating deal. Because just to give you a small example, we are just seeing Olympics right now, isn't it? So we can take an example from Olympics. 20 people participate in Olympic, but 3 get medal and 1 get gold. Every player may not get a gold, and hence every company may not become a billion-dollar company. But you have spent 10, 15 years in that company and given your sweat. What if the outcome is like $100 million, $200 million? It's not a small outcome, it's a great outcome, and hence you need to capture value in that outcome. And take a scenario where you have just your outcome is $100 million, but you have raised $80 million to reach to that $100 million. Then $80 million will straight jacketed go to the liquidation preference, and you will left with $20 million. But if you agree for a participating liquidation preference, you will not even left with that. You will get with very, very small capital. So push back hard on participating liquidation preference if it is in your term sheet. A normal standard is non-participating, and typically most of the investors I have seen, they keep 1x or 2x in non-participating. People are fine with keeping 1x of non-participating liquidation preference. At times when founders push hard on valuation a lot, and investors is willing to negotiate on the valuation, they end up in giving you a higher valuation and increasing the liquidation preference. My sense is that you should think hard to do that trade. At times you may be better off to agree for a lower liquidation preference and a lower valuation, because once you set a liquidation preference, it's very difficult to change it in future rounds. Future rounds also keep on keeping the same liquidation preference. So whenever you start with a high liquidation preference, it becomes a very painful exercise for you as a founder, and your goalpost and your exit size keep increasing. So think about it. If you are negotiating and trading liquidation preference with a valuation, in my opinion, it's not a very great call. And push hard if it is a participating liquidation preference. Founder vesting schedule is, in my opinion, is fairly easy to understand, and I think founders should be fine to give it. Basically, VC is saying that, look, I'm investing behind a team. What if you leave your company in year 1 or year 2, your equity, hence your equity should get vested. So typically people look for 3 years or 4 years of vesting schedules in early stage when you do a seed or series A. Obviously, when you are at series B or series BC, nobody asks. People are fine with earlier vesting schedules. And in my opinion, it should be fine to agree for a vesting schedule if you're not preparing to leave the company. And obviously, if you're leaving the company, then you should not raise capital. Having said that, in longer documents, people put some exceptions in vesting schedules. So, for example, if something happens, God forbid, accident happen or something happens, and you are not able to work at all, then vesting schedule will not kick in. You will get your own equity. So lawyers will advise you on that. Typically, those are very standard things. ROFR, co-sale, and tag along. Again, the same thing as VCs is saying that, look, I am investing behind the team. ROFR is right of first refusal. So if you are selling your stake to somebody else, then I need to, and I should have the option to buy it first. So that's what the fundamental VC is saying. So that's ROFR. Co-sale and tag along is that, look, I have the option to buy, but if I don't have to buy and still you are selling your equity to somebody else, then I need to sell my equity along with you. So basically, I am saying that if you are going out and you are exiting, then I need to exit too. Don't exit without me. Having said that, in co-sale and tag along, people are fine making a small carve out for your personal needs, because let's say you are worked in you're founding the company for 6 years. Obviously, you need some liquidity for your personal life. Then you are able to sell it. So pretty much people do carve out 1%, 2%, 3% kind of number when you put a co-sale or tag along. Buyback and drag along, some of these at times looks very draconian in nature. People put some like if 7 years or 8 years you are not able to exit, or you are not able to give go IPO or exit or M&A, then I'll ask the company to buy back at a certain IRR, or I can drag the entire shareholders and sell it to a company. When you read it first, they comes out at a fairly draconian in nature. Having said that, I have not seen them play out in a practical life. In a practical, I have never seen them play out, and the reason for that is that drag, personally, unless as a founder your ownership goes to like low single digit number, any incoming investors want a buy-in from the founder. Nobody wants to buy a equity 100% of a company where the founder buy-in is not there. Who will transition the business? Who will do post acquisition integration? Nobody buys the company without founder buy-in. So I have never seen playing out drag along irrespective of founders' wishes. Typically, founders are on board when everybody says that, look, it's been 10 years, let's come together and try to sell the company to somebody. I've always seen that founders are on board. On buyback, they are fairly tough to execute in the Indian scenario. The law doesn't give you necessary provisions to buy back from company. So fundamentally, these are commercial understanding, guys. They are not that legally strong, but these are commercially understanding that, look, you have shown me a 10-year dream, and if in 10 years you are not able to do it, then we need to exit to somewhere. It can't be lifestyle or a cash flow business for you. This is again interesting, and you should spend some time here on this slide because I've seen founders getting too penalized in anti-dilution rights. And take a COVID scenario. So let's say you raise capital in 2019 at $10 million. You raised post-money, you raised $2 million, and COVID happened, and your company got hit hard, and you finish with your money, and you raise another capital. But the new investor is saying that, look, I can't pay you 10, I can pay you but 7. So it is like a lower round than your past round, because the company is kind of, in COVID, everything got washed out. So it's a lower valuation, and then the anti-dilution says that, look, the initial investor invested at $10 million, and now the company value is 7, and hence you need to compensate the initial investors in terms of more equity ownership, because my value has got distracted. So that's the whole concept about it. And there are two forms of those anti-dilution. One is full ratchet and another is weighted average. Full ratchet is fairly penalizing to founders, and you should never agree to full ratchet in your term sheet. So again, same example I've given you. Series A happened at $10 million and you diluted 20%, 10%. Series B happens and you lower valuation and 20%. So full ratchet means that you need to convert my initial capital to the current valuation. So instead of my 10%, I'll now own 20%, because now your post money is $50 million. So that's the full ratchet. The weighted average formula is not here. It's a little bit complex, but fundamentally weighted average is that somewhere in between. It's not 10%, it's not 20%. It's a weighted average of both the rounds and capital, and you arrive at some number like 14-15%. So you should always agree for weighted average. Full ratchet just dilutes the entrepreneur equity practically fully. These examples I've taken are very at times I've seen like entrepreneur entire equity is getting wiped out in dilutions, and it's a very mucky and not a pleasant experience with the board and with shareholders to talk to. So you should always agree. No, and typically now I have not seen funds pushing for a full ratchet anti-dilution. I have typically seen funds also keeping just a weighted average anti-dilution. Other rights are information rights. People are saying that, look, I need information on time, I need company data. I think it looks fine. You should go through what information people are asking, unless it's very cumbersome or for you to cumbersome to give. I don't see much issues in information rights. Affirmative rights are typically If investors is coming on a board, they say that, look, you can't do these 10 things without my vote on the board. So those are few operational rights, and they can be like, you can't do a capex beyond a certain amount, you can't take debt, and they're like bunch of those affirmative rights, 10 12 rights which people ask for. Preemptive rights we can leave. The only thing is in affirmative rights and information rights is that you should put some threshold ownership. So let's example, I'm a 20% shareholder, affirmative right may make sense, but if I'm 3% shareholder, then affirmative rights may not make sense. So you should make sure that there is a threshold cutoff on ownership in your documents. As soon as the old investors keep, so see, the company journey is that as you grow, you get new investors, the older investors get diluted, and as the older investors get diluted beyond a point, they should not have these rights, because it's unfair for the company and unfair for the founders that such a small shareholder have these rights. Only a chunky shareholder should have these rights. So you should put some of those threshold things in this. Yeah, pretty much this is what I have. But lastly, my 3 4 and conclusive points on term sheets is that try to keep your term sheet very very simple. Try to see that all incentives or all stakeholders are aligned. If you are doing something, if you are making it too complex and seeing that your incentives are not aligned with your shareholders, then if not today, then down the line something will blow up. So keep your term sheets very very simple. Don't Early rounds are also set the precedent for future fundraising. They set the tone. So if you trade, let's say you want higher valuations and you're willing to get it, you're happy you're getting it, but investors is asking for a very penalizing liquidation preference or something complex, then think twice about it, because it set the tone for future round. If you are giving a expensive liquidation preference or expensive anti-dilution right, these things will stay on, and they will hit you hard at the time of exit, and especially if it is a suboptimum exit. So that you should always keep in mind. On affirmative rights, there should always be threshold. The threshold typically is 5% in the industry. At times people take 4%, at times 6 7%, but typically 5% is a good threshold. And if you are getting term sheet too quickly, and the history of the investor says that they don't give term sheet quickly, then you should be very mindful of taking it, because term sheet is a legally non-binding document, and at times investors start thinking about the round after they give term sheet, which is not good for you, because you get stuck in that round for a while.